Welcome to Learn Wealth, your go-to channel for real estate insights, market charts, and golden opportunities.
Hey everyone, it's James Santiago here with Learn Wealthy. Now I don't know about you, but every time I hit the grocery store lately, it feels like things just keep getting more and more expensive. And guess what? I'm not imagining it, and neither are you. The latest CPI report just dropped October 10, 2024, and inflation is still hanging around like that annoying friend who just won't leave you at the party. But let's back up for a second. What exactly is the CPI? It stands for Consumer Price Index, which is basically a fancy way of saying how much more or less are you paying for the stuff you buy every day. Think of it as the ultimate price tag for everything in your life. Groceries, rent, gas, you name it. And here's where it gets interesting. According to the latest numbers, headline CPI, that's the overall number, rose by 3.7% year over year. It sounds small, right? Well, hold on. That's just the average. You and I both know that some prices have gone up way more than others. Take gas, for example. It's up 10.6% in just a single month. If you've been cringing every time you fill up your car, now you know why. And groceries, they're not giving us much relief either. It's up about 3%. I mean, when did eggs become a luxury item? But here's where things get a little bit tricky-dicky. There's something called the core CPI, which is a number that strips out the volatile stuff like food and energy. The idea is core CPI gives us a clear picture of inflation. In this latest report, core CPI rose by 4.1% year over year. That's actually down a bit from the previous report, which could be a sign that inflation is cooling off. And to think inflation would have been low before Election Day. And let's not forget, we're still above the Federal Reserve's target of 2%. And here's the kicker. Rent, one of the biggest monthly expenses for most people, is still climbing. Shelter costs rose by 7.2%. So if you're renting, I bet you felt that pinch. But here's something no one in the mainstream news is really talking about. We could be dealing with a financial crisis today, too, when the stock market is showing an even bigger bubble based on the Buffett indicator, and the housing market is in a larger bubble per Case-Shiller index adjusted for inflation. Now let's talk about jobs, because the Federal Reserves always like to talk about jobs in relation to inflation, the Phillips curve. The recent BLS report showed that the job market is holding up okay. But hold on a second there. Yeehaw! It's election time, and you know what that means. There's a good chance the BLS could have overstated those job numbers. Remember how they like to quietly revise those numbers downward later when it's not front page news and they don't scream about it in the mainstream media like they usually do? And how just a couple of months ago they downwardly revised 818,000 jobs. Does that sound familiar to you? Don't you know that back in 2007 they were doing the same thing? Revisions after revisions, all while mainstream news was telling us that the economy was doing great. Banks were already starting to fail, but the news wasn't covering them. Or they would talk about it for like a couple of days and they would paper over it because the narrative was all about how the economy was strong back in 2007. By the time the crisis hit, it was too obvious to cover up. And we were already in the middle of a global meltdown. And like always, the entity that declared recession 1 year later.
A lot of Americans may feel that we've been in a recession for some time, and now, according to the National Bureau for Economic Research, they would be right. That private, not-for-profit group has declared that a recession began in December of 2007.
So why isn't the same thing happening today? Maybe it's because consumer spending is still high for now, propped up by inflated stock and housing values. Or maybe it's because the media isn't ready to say it. Hey, we might be in a repeat of 2007, but we've seen this movie before, and we know how it ends. Take rent, for example. Back in 2007, housing costs were coming down because of the crisis. But today, rent is up 7.2% from a year ago. And let's not forget about gas. It spiked over 10% just last month. So while the Fed's rate cut in 2007 was meant to stop a meltdown, today's rate cut is about trying to keep the economy going without letting the inflation run wild. So what does this all mean for you? In 2007, lower rates helped some people borrow and spend more. But ultimately, it couldn't stop the coming recession. Today, with inflation still high, rate cuts might help in the short term by lowering borrowing costs, but it won't fix the core issue of high prices. You still have to be smart with your money. And based on these charts, majority of the job loss happens during the gray bars, which are the recessions. And when that gray bar hits, a really fast disinflation can happen just like that. To sum it up, back in 2007, the Fed was dealing with a financial crisis that was quietly brewing beneath the surface. Inflation wasn't a problem, but collapsing banks were. Both 2007 and 2024 have overinflated stocks and housing markets. And the job numbers right now might not be telling us the full story. It's looking a lot like 2007 again, but this time, the bubbles are even bigger. That is why staying informed is more important than ever. At Learn Wealthy, we're not here to sugarcoat the facts. We're here to break it all down so you can see the bigger picture before it's too late. For more finance, investing, real estate, and macroeconomics, let's all learn wealthy together. Hit that subscribe button and I'll see you in the next video.